Welcome back. Today we're going to take some time to review and expand on our understanding of bonds as a source of long-term debt financing. Bonds are, in essence, notes payable issued by companies borrowing money from the general public rather than from some bank or other financial institution. Upon issuance of bonds, a company receives cash from investors and incurs an obligation to repay that amount plus interest over time. By the way, most bonds are issued by publicly held companies and typically involve large amounts of money borrowed on a long-term basis. The actual issuance or sale of bonds to investors is usually done through investment banking companies and is facilitated by dividing up the total face or par value of the bonds, or in other words, the total principal amount payable under the bonds, into smaller bond certificates with denominations that are typically set at $1,000 each. For example, a company borrowing $100 million will typically issue 100,000 $1,000 bonds. Once issued, investors will sometimes sell their bonds to other investors in a secondary market. This allows them to effectively cash out of their investment prior to a bond's maturity. However, from the company's or bond issuer's standpoint, these secondary transfers have no financial impact except that all future payments to be made under the bonds must be made to a different bond holder. By the way, when bonds are traded in a secondary market, registered bonds require any change in ownership to be registered with the issuer before payments are made to the new investor. On the other hand, coupon or bearer bonds require no such registration, and payments are simply made to those who have physical possession of the bonds. In the United States, almost all bonds are registered as opposed to coupon or bearer bonds. The detailed terms and conditions of a bond are documented in a written agreement referred to as a bond indenture that's held and enforced by a designated trustee acting on behalf of all bond holders. This legal document spells out the timing and amount of future payments of principal and interest, as well as other provisions dealing with security, payment priorities, callability, convertibility, and any other rights and obligations that may exist under the bonds. In many cases, a company's bonds are actually described based on the indenture's provisions. For example, term bonds refer to bonds that provide for payment of the entire principal or face value of the bonds at a single specified date. Serial bonds, on the other hand, provide for principal payments in installments over time. Secured bonds pledge specific assets as collateral in the event of an issuer's default. These bonds are also known as collateralized bonds. Debentures are unsecured bonds. Senior or subordinated bonds specify certain priorities of claims that bondholders may have against the assets of the issuer relative to the claims of other creditors. Callable bonds allow an issuer to make payoffs at agreed amounts prior to maturity. Convertible bonds allow bondholders to convert their bonds to stock after a specified period of time. Sometimes bonds are characterized based on the creditworthiness of the issuing company. For example, junk bonds are bonds issued by companies with low credit ratings. They're also frequently referred to as high-yield bonds because they typically pay a higher than average rate of interest. They have to attract investors. The interest rate payable on a bond, or its stated rate, is affected by more than just a company's credit rating. Obviously, the level of interest rates in the overall economy, plus other things like the term of the bonds, the nature and extent of any collateral, and provisions for callability and convertibility, will have a significant impact on a bond's stated interest rate. Generally speaking, shorter-term, convertible, secured bonds issued by AAA-rated companies will pay lower rates of interest than longer-term unsecured bonds. Let's walk through this problem, which indicates that on November 1st, X3, Stagg Corporation issued $10 million of 5-year term bonds at face value. Assuming a 7% stated interest rate, payable semi-annually, You were then to prepare journal entries to record first the issuance of the bonds on November 1st of X3. This entry is made by debiting cash for $10 million and crediting the liability bonds payable in the same amount. The $10 million is the face value or principal amount of the bonds payable at the end of the 5-year term. This is also sometimes referred to as the par value of the bonds. The fact that the bonds were issued at face or par value means that the full $10 million principal amount was received upon issuance of the bonds. In B, you were to account for the 20x3 interest expense given a calendar year in. This requires an adjusting entry at 12/31x3, which would include a debit to interest expense and a credit to interest payable for the 2 months of interest accruing on the bonds from November 1st to December 31st. That amount is calculated by taking the $10 million principal balance times 7% annual interest times 2 over 12 months for $116,667 rounded. Next, you were to record the payment of interest on May 1st of X4. That's done by first crediting cash for $350,000. That's the amount of the semi-annual interest payment given the $10 million principal balance times 7% interest for 1/2 of a year. Part of that payment represents payment of the 2 months of previously recorded interest payable for $116,667. The difference is $233,333 and is debited to interest expense and is the cost of interest for the 4 months from January 1st through May 1st of X4. The journal entry to record the payment of interest on November 1st of X4 is made with a credit to cash for the semi-annual payment of $350,000 and a debit to interest expense for that full amount. This is the cost of interest for the 6-month period from May 1st to November 1st of X4. Now, although we weren't asked to do this, an adjusting entry would again be made on December 31st X4 to record the 2 months of unpaid interest at the end of the year. That includes a debit to interest expense and a credit to interest payable for $116,667. And the same entries would be made in each subsequent year throughout the term of the bonds to record the company's interest payments and interest expense. Finally, in E, you were to record the final payment of interest and principal on November 1st of X8. This entry includes a credit to cash for $10,350,000 and debits to interest expense for the final $350,000 semi-annual interest payment and bonds payable for the $10 million principal payoff. This payment could have also been made in 2 separate entries if you wanted to. Either way, the ultimate result's the same. You know, it's not all that uncommon for bonds to be issued at a price that's higher or lower than the face value of the bonds. In other words, bonds are often issued at a premium or a discount. This happens when a bond's stated rate of interest differs from the market rate demanded by investors at the time the bonds are issued. Let me demonstrate that through the following example. Let's assume on December 15th of 20X4 finalizes its bond indenture and prints certificates for a planned December 31st issuance of $1 million of 3-year term bonds bearing interest at a stated rate of 6% payable annually. This 6% rate is based on market rates at the time the indenture is finalized. Let's also assume that on the date of issuance, 16 days later, market interest rates have increased, and investors are now demanding a 7% return on any investment in the bonds. You know, market rates can fluctuate daily or even hourly as investors respond to changing economic conditions. In fact, a bond stated rate rarely matches its market rate at the time of issuance. That can create a real problem. In fact, now has $1 million of bonds with no interested investors. Investors expect or want a 7% return, and the bonds only offer 6% interest. In most cases, companies solve this problem by offering the bonds at a discount, or in this case, would simply offer the bonds at a price below the $1 million face value to provide investors with an effective 7% return on their investment. Let me show you how this works using this graph, reflect future obligations under the 3-year 6% bonds. Here's the face amount or par value of the bonds, the $1 million due at the end of 3 years. plus the annual interest payments of $60,000 a year at the 6% stated rate. If investors were to pay the full $1 million face value of the bonds for these promised future payments, the investor's return would be equal to the 6% stated interest rate. $60,000 a year is equal to 6% interest on $1 million. If, however, investors were to pay less than $1 million for these promised future payments, then the investor's annual return would be higher than the 6% interest rate. $60 million a year earned on an amount less than $1 million means an effective interest rate that's higher than 6%. Plus the excess of the $1 million to be received at the end of 3 years over the amount originally invested represents additional interest. The point here is that the issuance of the bonds at a discount, or an amount less than the face value of the bonds, is a way to increase an investor's return over and above the stated 6% rate. The question then is, how much of a discount is required to produce a 7% rate of return, or the current market rate demanded by investors? This is easily solved through the use of time value of money concepts. Think of it this way. How much would someone have to invest today, earning an annual rate of 7%, to generate the cash flows promised under the 6% bond, the $60,000 at the end of each year for 3 years, plus $1 million at the end of the 3rd year? Or, in other words, what is the present value of those future cash flows at an interest rate of 7% compounding annually? That calculation is made by adding the present value of an annuity of $60,000 at the end of each year for 3 years at an interest rate of 7% compounding annually, which equals $157,459 rounded, plus the present value of the $1 million single cash flow at the end of 3 years at the same rate, which equals $816,298, for a total present value of $973,757. This means investors paying a total of $973,757 for $1 million 6% bonds will earn an effective interest rate or annual yield on their investment of 7%. That $973,757 is referred to as the current market value or the price of the bonds, and is usually stated in terms of a percentage of the bond's face value. In this case, the bonds would be priced at 97.4 rounded, or 97.4% of the $1 million face value of the bonds, to yield an effective rate of 7%. Now, let's take a moment and look at accounting for the issuance of these bonds if we assume they're issued at this current market price on December 31st, X4. The journal entry in this case includes a debit to cash for $973,757, a credit to bonds payable for the $1 million principal amount due at maturity, and a debit to an account referred to as discount on bonds payable for the difference, or $26,243. This discount on bonds account is really deferred interest expense. It receives $973,757 of cash upon issuance of the bonds, yet is obligated to pay $1 million at maturity. The difference is, in effect, an additional interest cost above and beyond the $60,000 of interest payable at the end of each year. This additional interest should be allocated or amortized to expense over the 3-year term of the bonds. That's done at the end of each accounting period by crediting the discount on bonds account and debiting interest expense. In this case, the amount of the entry is $8,748 using a straight line approach, which takes the $26,243 discount and divides it equally over the 3-year term of the bonds. This straight line method is acceptable only if the $8,748 amount doesn't differ significantly, with results that would otherwise be obtained under a more accurate effective interest method, which takes into account the time value of money. In addition to this recording of the discount to interest expense, an additional entry is required to record the actual $60,000 payment of interest at the end of the first year. That's made with a credit to cash and a debit to interest expense for $60,000. This is the bond's stated interest at 6% times the $1 million face value of the bonds for 1 year. The entries to record this payment of interest and amortization of discount are usually combined into one entry with a debit to interest expense for the combined total of $68,748 and credits to discount on bonds and cash in the respective $8,748 and $60,000 amounts. If we take this $68,748 of total interest expense for the year and divide it by the amount actually borrowed upon issuance of the bonds, the $973,757 of cash received, we get 0.071 rounded, which means that the cost of borrowing was about 7%. That makes sense given that the price of the bonds was determined using a 7% effective or market rate of interest. In fact, this cost of borrowing should really be exactly 7%, not 7.1% or something close to it. If we calculate the true interest cost at an effective 7% rate, taking the $973,757 amount borrowed times 7% for 1 year, this $68,163 is the amount that really should be recorded here as the true interest expense for the year. The difference in these two amounts reflects the difference in discount amortization under the straight line method and the more accurate effective interest approach. This $8,748 amount was calculated and included in interest expense using the straight line method. The effective interest method takes this true interest cost here and records that as the amount of total interest expense for the year, adjusting the discount amortization appropriately, given that $60,000 of that interest was paid in cash. In other words, the process of effective interest amortization begins with the calculation and recording of total interest expense for the period based on the effective interest rate times the actual amount borrowed, and then the difference between that amount and the amount of interest actually paid is the amount of discount amortization recorded for the period. In most cases, these calculations are simplified through the use of a schedule like the one shown here. Here, you can see the first-year calculation of discount amortization based on the total $1 million of bonds payable, less the $26,243 beginning balance of the bond discount, or $973,757, which is the actual amount borrowed, times the 7% effective interest rate for total interest expense of $68,163 rounded. Of that amount, $60,000 is paid in cash, which leaves $8,163 of discount amortization. In the second period, or in this case the second year, this process is then continued by taking the $1 million of bonds payable less the $18,080 updated balance of the bond discount for a $981,920 net amount. By the way, this updated discount balance comes from the $26,243 original discount, less $8,163 of first-year amortization. The deduction of this amount from the $1 million of total bonds to get the net $981,920 payable implies that this balance of bond discount is really a contra liability account. In fact, if we were to prepare the company's balance sheet at the beginning of this second year, under long-term liabilities, we'd show bonds payable less the $18,080 discount balance for a net liability of $981,920. This balance is also referred to as the bond's carrying value or book value, and can alternatively be determined by taking the amount originally borrowed, the $973,757, and adding to it the first year's discount amortization of $8,163, which comes to the same $981,920 amount. This reflects the company's true liability based on the amount borrowed plus unpaid interest to date. That's what this amortized discount really is. It's recorded interest expense that hasn't been paid and won't be until the full $1 million face value is paid at maturity. In effect, it's interest payable and properly included as part of the bond liability. By the way, the amount of this carrying value is also consistent with generally accepted accounting principles, which state that long-term liabilities should always be reported at the present value of the future cash flows payable. If we calculate the present value of the two remaining future cash flows payable under the bonds at the beginning of 20x6, the present value of the $60,000 annuity for the two remaining years, plus the present value of the $1 million single cash flow at the end of the second year, the total comes to $981,920, the current carrying value of the bonds payable. Now, let's take this effective interest schedule over to another page and finish up the calculation of bond discount amortization for the second period, taking the $981,920 carrying value times the 7% effective interest rate for total interest expense in 20x6 of $68,734 rounded. The $60,000 interest payment is then deducted from that amount to determine the $8,734 of bond discount amortization in this second year. The combined journal entry to record this at 12/31x6 would include a debit to interest expense for the $68,734 total, with credits to cash for $60,000 and discount on bonds for $8,734. In the third period, or in this case the third year, this process is duplicated by taking the $1 million of bonds payable less the remaining $9,346 balance of the bond discount, the $18,080 previous balance less the second year's $8,734 discount amortization, for a carrying value of $990,654. Again, this carrying value increased over the prior year's balance by the amount of the second year's discount amortization, which is, in effect, recorded interest expense that's payable in the future. If we then take this carrying value times the 7% effective rate, we get $69,346 of total interest expense for the third year. And if we again subtract the $60,000 of interest actually paid, the amount of bond discount amortization comes to $9,346, which is equal to the full amount of the discount at the beginning of the year. In other words, the discount will have been fully amortized over the 3-year term of the bonds. Again, the journal entry at 12/31x7, the end of the third year, includes a debit to interest expense for $69,346, with credits to cash for $60,000 and discount on bonds for $9,346, along with an additional entry to record the payoff of the bonds at maturity, with a credit to cash for $1 million and a debit to bonds payable in the same amount. Following these entries, no remaining balances exist in either the bonds payable or the discount on bonds accounts, which is the way it should be after the complete payoff of the bonds. Okay. This problem states that on October 1st, X4, Owens Corporation issued $10 million of bonds at a price of 98. Assuming the bonds have a 4-year term and bear interest at a stated rate of 6%, payable semi-annually, you were then to prepare the journal entries to record first the issuance of the bonds on October 1st, X4. That's done by initially debiting cash for the amount actually received. In this case, the $10 million of bonds were issued at a price of 98, which means 98% of the $10 million face value of the bonds. That's $9,800,000 of cash. Bonds payable is then credited for the $10 million amount. The difference between the $10 million and the $9,800,000 of actual cash received is $200,000, which is then debited to discount on bonds or discount on bonds payable, and represents an additional interest cost of borrowing. That $200,000 cost will be amortized to interest expense over the 4-year term of the bonds to comply with. The next entry is for the 12/31 X4 adjustment for 20 X4 interest expense using the straight-line method of bond discount amortization. That's done by first crediting interest payable for the stated interest on the bonds for the last 3 months of the year 20x4. That's calculated by taking the $10 million face value of the bonds times the 6% stated rate for 3 months, which comes to $150,000. This is the interest to date that's payable when the first semi-annual interest payment is due on April 1st of X5, 6 months after the original issuance of the bonds. In addition to this stated interest, a portion of the bond discount must also be amortized to accurately reflect the total cost of borrowing in 20x4. That's done by crediting discount on bonds in an amount that's equal to $200,000 divided by 4 years or 48 months times 3 for the last 3 months in 20x4. That comes to $12,500, which is the amount of the credit. The debit is then to interest expense for the total effective interest cost of $162,500. The next entry is for payment of interest on April 1st of X5. This calls for a credit to cash for $300,000. That's the semi-annual payment of stated interest based on the $10 million face value times the 6% rate for 6 months. The discount on bonds account is also credited for $12,500, representing 3 months of the $4,167 monthly discount amortization. The debits include a debit to interest payable for the $150,000 amount of previously recorded 20x4 interest, plus a debit to interest expense for $162,500, which includes the $150,000 of stated interest for the first 3 months of X5, plus the $12,500 of bond discount amortization for the same 3 months. In reality, the recording of this discount amortization isn't absolutely required at this time. That portion of the entry could be deferred, as long as it's subsequently included in an adjusting entry at the end of the year. However, its inclusion at the time interest payments are made is probably the more common approach. Now, let's record the next semi-annual payment of interest on October 1st of X5 with a credit to cash for $300,000, reflecting the stated interest based on the $10 million face value times 6% for 6 months. The discount on bonds account is also credited for 6 months of the $4,167 monthly discount amortization for a total of $25,000, and interest expense is debited for the combined amount of $325,000. At December 31st of X5, an adjustment for the remaining 3 months of 20x5 interest expense is made with credits to interest payable for $150,000 and discount on bonds for $12,500. The debit is to interest expense for the combined total of $162,500. You were then asked a number of questions. First, what are the carrying value of the bonds on Owen's 1231X4 and 1231X5 balance sheets? These values are determined by taking the face value of the bonds less the balance of the discount on bonds at each of those dates. The face value doesn't change and is the $10 million amount of bonds payable. The discount on bonds balance can be easily determined by setting up a T account with the beginning $200,000 balance recorded on October 1st X4. The adjusting entry made for amortization of this discount in 20X4 was for $12,500, leaving a $187,500 balance at the end of the year. In 20X5, the 3 entries made to record the discount amortization totaled $50,000, for an updated balance of $137,500 at 1231X5. If we then deduct those balances from the $10 million face value of the bond, it gives us a carrying value of $9,812,500 and $9,862,500 at the end of 20X4 and X5 respectively. Those amounts reflect the net bonds payable to be shown on a balance sheet at the end of each year. You were then asked, why does the carrying value of bonds payable increase over time? Well, since the carrying value is equal to the face value of the bonds less the balance of any bond discount, The amortization and reduction of that discount over time will automatically increase the bond's carrying value. In fact, when the bonds finally mature and the discount is fully amortized, the carrying value will equal the full face value of the bonds or the amount due at maturity. This carrying value can also be determined by adding the amount of any unpaid interest expense to the amount originally borrowed under the bonds. In other words, the bond's carrying value is also equal to the amount of discount amortization to date plus the amount of cash received upon original issuance. And since the total amount of amortized discount increases over time, the carrying value will automatically increase as well. You were then asked, is the effective interest rate on the bonds higher or lower than the stated 6% rate? The answer is, it's higher. When bonds are issued at a discount, it creates a higher cost of borrowing. That can be proven through our response to the final question, which asked, what was Owen's total interest expense in 20x5, and how does it compare with the stated interest actually paid? Owen's 20x5 total interest expense was recorded in 3 separate entries. If we went back to our journal entries, we'd find $162,500 recorded on April 1st, an additional $325,000 recorded on October 1st, and $162,500 on December 31st, for a $650,000 total for the year. That total is higher than the $600,000 of stated interest paid based on 6% times the bond's $10 million face value. Okay, in this problem, you were asked to prepare journal entries assuming the bonds are issued at a price to yield an effective interest rate of 7% compounding semi-annually. In this case, before we can make any journal entries, we'll first need to determine the issuance price of the bonds. That's done by summing the present value of all future cash payments required under the bonds using a 7% interest rate compounding semi-annually. Those future cash payments include a $300,000 annuity payable at the end of every 6 months for 4 years, which is the interest payable under the bond's 6% stated rate. $10 million times 6% for 6 months of a year, it comes to $300,000 payable semi-annually. In addition, the bonds require payment of a $10 million single cash flow at the end of the 4th year. That's the face value or par value of the bonds due at maturity. If we then take those 2 amounts and add them together, we get a total combined present value of $9,656,303. That's the amount investors are willing to pay for the bonds if they demand a 7% effective return on their investment. In other words, it's the price of the bonds to yield an effective interest rate of 7% compounding semi-annually. Now, let's go ahead and make the appropriate journal entries. First, for the issuance of the bonds on October 1st, X4. That's done with a debit to cash for their issuing price of $9,656,303. Bonds payable is credited for the full $10 million face value or maturity value of the bonds, and the account discount on bonds is debited for the difference, or $343,697. The December 31st X4 adjustment for 20X4 interest expense is then made with a credit to interest payable for $150,000 based on the $10 million face amount of the bonds times the 6% stated interest rate for the last 3 months of the year, October, November, and December. In addition, the discount on bonds account is credited for 3 months of discount amortization using, in this case, the effective interest method. Let's take a moment and determine that amount using this schedule format provided here. Under this method, calculations must be made for each interest compounding period, which in this case is each 6-month period given effective interest compounding semi-annually. Once that first 6-month amortization is determined, then 3 months' worth, or half of that amount, will be used for this December 31st X4 entry for the last 3 months of the year. Let's go ahead and do that by first taking the $10 million of bonds payable less the $343,697 balance of bond discount for a carrying value at the beginning of the period of $9,656,303. That's the amount that was actually borrowed upon issuance of the bonds. That amount's then multiplied times 3.5%, which is the effective 7% rate divided by 2 for semi-annual compounding, which then gives us $337,971 of interest expense for the 6-month period. If we then deduct the $300,000 of stated interest paid at 6% for 6 months, the amount of bond discount amortization for the period comes to $37,971. Now remember, that's the amortization amount for 6 months. In order to account for the 3 months of October through December of X4, this amount must be multiplied by 3 over 6, or 1/2, giving us $18,986 rounded as the amount of discount amortization to be recorded at this time. That amount's credited to discount on bonds account. The debit entry is made to interest expense for the combined total of $168,986. Our next entry is for the first actual semi-annual payment of interest on April 1st of X5. This is made with a credit to cash for $300,000 based on the stated 6% interest rate for 6 months. Of that amount, $150,000 represents payment of the interest payable previously recorded in 20X4. The remaining $150,000 is interest expense for the months of January through March of the current year X5. However, that amount should really be increased by 3 months' worth of bond discount amortization. That's recorded with a credit to discount on bonds for $18,985, the remaining 3 of the first 6 months' amortization, and the debit entry to interest expense is increased to $168,985. Next, the payment of interest on October 1st X5 is recorded with a credit to cash for the next semi-annual payment of $300,000, along with a credit to discount on bonds for the amortization associated with the next 6-month period. Let's go ahead and update our amortization schedule shown here for that second period by taking the $10 million of bonds payable less the updated balance of the discount on bonds, which is $305,726, given the original $343,697 discount, less the first 6 months amortization of $37,971. The net carrying value is then $9,694,274, which is multiplied by the 3.5% effective semi-annual rate of interest for $339,300 of total interest expense. If we then deduct the $300,000 of stated interest paid, the difference is the discount amortization for the second 6-month period, which is the amount to be credited to the discount on bonds account in this entry. The debit is then to interest expense for the combined amount of $339,300. Finally, the December 31st X5 adjustment is required for the remaining 3 months of 20X5 interest expense. That's done by crediting interest payable for $150,000, the last 3 months of stated interest, along with a credit to the discount on bonds account for 3 months or half of the third 6-month period's discount amortization. Let's go ahead and determine that amount using our schedule and updating it for the third 6-month period. Again, we'll take the $10 million of bonds payable and deduct the $266,426 balance of bond discount for a $9,733,574 carrying value at the beginning of that 6-month period. That carrying value is then multiplied by the 3.5% semi-annual effective interest rate for $340,675 of total interest expense for the 6-month period. If we then deduct the $300,000 of stated interest actually paid, we get $40,675 of discount amortization. Again, this amount is the discount amortization for a 6-month period, and to properly account for 3 months of amortization at the end of the year, this amount must be multiplied by 3 over 6 months, or 1/2. This $20,338 amount is then credited to the discount on bonds account, and the debit interest expense is made for the combined total of $170,338. You would then ask this question: why are bonds sometimes issued at a discount rather than their face or par value? Simply stated, if the market interest rate or the rate demanded by investors increases above a bond's stated rate prior to the issuance of the bonds will have to be discounted to create any investor interest in the bonds. As we've discussed, it's not uncommon for companies to make arrangements for the issuance of bonds at a certain stated rate of interest, only to see market rates change prior to actual funding. When interest rates increase, a company will have to offer the bonds at a discount to attract investment dollars. On the other hand, if market rates decrease prior to funding, the bonds will be issued at a premium. This means the price of the bonds, or in other words, the amount of cash received from investors upon issuance, will be greater than the face or maturity value of the bonds. Let's assume finalizes its documentation for the issuance of 3-year term bonds with a total face value of $1 million, bearing interest at a stated rate of 6% payable annually. Now, if market rates decrease to 5% prior to actual issuance, we'll obviously want to adjust the stated rate down before the bonds are issued. Hey, if investors are willing to fund the bonds at a lower interest rate, why pay the higher 6% rate? That should make sense. However, in actual practice, rather than change the stated rate, issuance of the bonds at a price above their face value will create the same economic effect. In fact, if we calculate the present value of the future bond payments at an interest rate of 5% compounding annually, we can determine the current or present value of the bonds at that current market rate. That calculation is made by adding the present value of a $60,000 annuity for 3 years at an interest rate of 5% compounding annually, which equals $163,395 rounded, plus the present value of the $1 million single cash flow at the end of 3 years at the same rate, which equals $863,838, for a total present value of $1,027,233. This means that at an issuance price of approximately 102.7, or 102.7% of the bond's face or par value, effective annual cost of borrowing, and the investor's annual return on investment will equal 5%. Now let's go ahead and take a moment to look at accounting for the issuance of these bonds at a price of $1,027,233 on January 1st, X5. The journal entry in this case includes a debit to cash for the full amount, a credit to bonds payable for the $1 million principal amount due at maturity, and a credit to an account referred to as premium on bonds or simply bond premium for the $27,233 difference. The premium on bonds account is really a deferred reduction of the company's bond interest expense. If it receives $27,233 more than the amount to be paid at maturity, that amount effectively reduces overall cost of borrowing or interest expense. The reduction of that interest expense should be deferred and spread out or amortized over the life of the loan. Similar to bond discount, this premium may be amortized on a straight-line basis if the results are not materially different from those obtained using an effective interest approach. Now, let's go ahead and account for the first year's interest expense using effective interest amortization as shown on the schedule provided here. In this case, the calculations are made on a 12-month or annual basis, given that the effective interest compounds annually. For the first 12-month period, we begin by taking the $1 million face value of the bonds and adding the $27,233 premium balance for a $1,027,233 carrying value, which is then multiplied by the 5% effective interest rate for total interest expense of $51,362. In effect, $1,027,233, the amount of cash received at issuance, and this $51,362 is the true interest cost at an effective rate of 5% on that amount borrowed for the first year. Since the actual interest paid at the end of each year amounts to $60,000 based on the bond's stated 6% rate, the amount of premium amortization, or the amount of the reduction in interest expense for the first year, is $8,638. Given this information, the journal entry to record interest expense for the year ended 12/31/X5 includes a debit to interest expense for $51,362, the true cost of borrowing for the year, a credit to cash for the $60,000 of actual interest paid, and a debit to premium on bonds for the year's $8,638 premium amortization. In short, the company's effective interest was equal to $60,000 of interest paid less 1 year's amortization of the premium received upon issuance. Now, let's take a moment and continue on in this schedule to make a few final points. In the second period, or in this case, the second year, the $1 million of bonds payable is the same, but the beginning balance of the bond premium has decreased to $18,595. That's equal to the original $27,233 premium, less the first year's $8,638 premium amortization. The total of the bond payable and premium is the bond's carrying value at the beginning of the year. And in fact, if we prepared balance sheet at this time, under long-term liabilities, bonds payable would be reported with the $18,595 premium balance included. You know, it may seem a bit weird that this liability includes the balance of the premium, since the company has no future obligation to repay any portion of that amount. Only future obligation is the payment of $1 million at the end of the third year, plus interest at a rate of 6% over time. However, if you think of the premium received as a future offset against the 6% stated interest of the bonds, then the balance is similar to unearned revenue. In essence, any premium balance is an unearned offset against future interest costs, which is substantially the same as unearned revenue. When cash is received up front and the benefits aren't earned except through the future passage of time, the balance of any unearned benefits is properly included as a liability. Now, let's go ahead and move this schedule to a new page and continue walking through it for the second year by taking the $1,018,595 carrying value times the 5% effective rate for total interest expense of $50,930 rounded. The difference between that amount and the $60,000 of stated interest produces $9,070 of premium amortization for the year. The journal entry to record this includes a credit to cash for the $60,000 amount paid, along with debits to premium on bonds for $9,070, and interest expense for the difference, or $50,930. In the third year, this process is repeated by taking the $1 million and adding the $9,525 remaining balance of the bond premium for a total carrying value of $1,009,525 times 5% interest equals $50,475 of total interest expense. If we then subtract the $60,000 of interest paid, the amount of bond premium amortization comes to $9,525, which is the full amount of premium remaining at the beginning of the year. In other words, the premium will have been fully amortized or recognized as an offset to interest expense over the 3-year term of the bonds. The final journal entries would include a credit to cash for the $60,000 of interest paid, with debits to the premium on bonds for the $9,525 premium amortization, and interest expense for the $50,475 difference, or the amount of effective interest expense. In addition, cash would be credited and bonds payable debited for the $1 million upon payment of the face value of the bonds at maturity. Well, that does it for bonds issued at premium. So let's go ahead now, and this problem states that on May 1st, 20X5, issued 2-year term bonds with a total face value of $10 million, bearing interest at 8% compounding semi-annually. The bond indenture provides for interest payments to be made on November 1st and May 1st of each year through maturity on May 1st, 20X7. You were then to calculate the issuing price of the bonds if they were priced to generate an effective interest rate to investors of 7.5%, 8%, and 8.5% compounding semi-annually. The issuing price or current value of a bond is equal to the present value of the bond's future cash payments using the current market or effective rate of interest. Bonds provide for 2 future cash payments. The first is a $400,000 annuity at the end of every 6 months for 2 years, based on the stated 8% interest payable semi-annually. The second is a $10 million single cash flow at the end of 2 years. That's the maturity payment based on the face value of the bonds. If we then calculate the present value of these future cash flows at an effective interest rate of 7.5%, the present value of the annuity is $1,460,554, and the present value of the single cash flow is $8,630,731, for a total present value of $10,091,285. In other words, if these bonds are issued at a price of $10,091,285, the effective rate of return to investors will be 7.5% compounding semi-annually. You know, the pricing of these bonds at a premium makes sense given that the bonds provide for payments of interest at a stated 8% rate, which is higher than the current market rate demanded by investors. In other words, investors would be willing to pay more for the bonds because they're going to pay a higher than market rate of interest. But let's go ahead and note the final answers here and make a few final observations. It's important to note that bonds issued to yield an effective rate of interest equal to the stated rate are issued at their face value or par value. If investors pay a price of $10 million for bonds that pay 8% interest on a semi-annual basis, then their return on investment is 8% compounding semi-annually. It also makes sense that when investors demand a rate of return higher than the 8% stated rate of the bonds, then the bonds must be priced at a discount to attract investment dollars. This problem provides that on May 1st, 20X5, issued 2-year term bonds with a total face value of $10 million, bearing interest at 8% compounding semi-annually. The bond indenture provides for interest payments to be made on November 1st and May 1st of each year through maturity on May 1st, 20X7. Assuming the bonds are issued at a price of $10,091,285 to yield an effective interest rate of 7.5% compounding semi-annually, you were asked to prepare journal entries to record first the issuance of the bonds on May 1st of X5. That's done with a debit to cash for $10,091,285 and credits to bonds payable for $10 million and premium on bonds for the difference, or $91,285. Next, the payment of semi-annual interest on November 1st X5 is recorded with a credit to cash for $400,000 based on the bond's $10 million face value times the 8% stated rate of interest for 6 months. The premium on bonds account is then debited for an amount we'll determine through an effective interest amortization schedule prepared in the format provided here. In this case, calculations are made in 6-month periods given an effective interest rate of 7.5% compounding semi-annually. Premium amortization for the first 6 months is then determined by adding the $10 million face value of the bonds plus the $91,285 premium balance for a total carrying value of $10,091,285, which is then multiplied by 3.75%, or the 6-month rate given effective interest at 7.5% compounding semi-annually, for total interest expense of $378,423. The difference between that amount and the $400,000 of stated interest paid for the 6-month period gives us $21,577 of bond premium amortization. That's the amount debited to premium on bonds in this November 1st entry, with an additional debit to interest expense for $378,423. This interest expense is equal to the $400,000 of interest paid, less amortization of the premium received upon issuance of the bonds. The next entry is for the December 31st X5 adjustment to record the last 2 months of 20X5 interest expense. This entry is made with a credit to interest payable for $133,333 based on the bond's $10 million face value times the 8% stated rate of interest for 2 months. But the debits for premium amortization and interest expense will come from our continuing amortization schedule. Here we'll calculate the second 6 months of premium amortization and then use 1/3 or 2 months of that amount for our entry at December 31st X5. Again, we'll start with the $10 million face value of the bonds and add the $69,708 premium balance for a $10,069,708 carrying value. That premium balance comes from the prior year's $91,285 balance, less the previous $21,577 of premium amortization. This carrying value is then multiplied by the 3.75% semi-annual effective rate of interest, giving us $377,614 of total interest expense. The difference between that amount and the $400,000 of stated interest at 8% for 6 months is the premium amortization for the period. Again, this is a 6-month amount, and in order to determine amortization for the 2 months of November and December, it's multiplied by 2 over 6 months. This $7,462 amount is then debited to the premium on bonds account, with the difference, or $125,871, debited to interest expense. You were then asked to determine the carrying value of bonds payable on Harrison's 12/31/X5 balance sheet. This equals bonds payable at the $10 million face value plus the premium on bonds balance at 12/31/X5. That balance can be easily determined by setting up a T account reflecting the $91,285 original premium upon issuance of the bonds, less the November 1st amortization of $21,577, and the December 31st amortization of $7,462, which produces an ending balance of $62,246. When that amount is then added to the $10 million, it produces the balance sheet carrying value of $10,062,246. You were then asked to prepare the journal entries to be made with final payment of interest and the payment of principal on May 1st of X7. The entry for the final semi-annual payment of interest is made with a credit to cash for $400,000 based on the 8% stated rate of interest for 6 months, and debits to interest payable for $133,333, interest expense for $250,603, and premium on bonds for $16,406. The $133,333 debit to interest payable reflects the payment of 2 months of stated interest payable for November and December of 20X6 that would have been previously recorded at December 31st of X6. The The $16,064 debit to premium on bonds is based on the completed amortization schedule, which shows $24,096 as the amount of premium amortization in the last 6-month period. That amount is then adjusted to reflect the amortization for the last 4 months from January through April of 20X7 by taking the $24,096 and multiplying it by 4 over 6 months. The $250,603 amount of interest expense is then equal to 4 months of stated interest at 8%, or $266,667, less the $16,064 of premium amortization. Finally, the entry to record the payment of principal includes a credit to cash for $10 million and an equal debit to bonds payable. As we've previously discussed, companies borrowing money through the issuance of bonds become legally obligated to make payments of principal and interest at specified future dates. It's interesting to note that even if a company wishes to pay off its bonds prior to maturity, the payoff and early retirement of bonds is generally prohibited, except in the case of callable bonds. This makes sense when you think about it. Most investors in bonds are attracted to the fixed rate of return provided over a long-term period of time. If companies are allowed to redeem their bonds prior to maturity, it can defeat the very purpose of the investment. In fact, the successful issuance of callable bonds usually requires the payment of a higher rate of interest and a call or redemption price that's greater than the face value of the bonds due at maturity. As a result, callable bonds are rarely issued unless a company truly believes future refinancing will be available at a lower rate of interest prior to maturity. For example, let's assume issues at face value $10 million of 8% interest-bearing 5-year term bonds, callable at a price of $103 or $10,300,000. Let's also assume that 2 years after issuance, interest rates fall from 8% to 5% and decides to refinance or pay off the old bonds by issuing $10 million of new bonds at the current 5% rate. This certainly makes economic sense if the interest to be saved over the remaining term of the bonds exceeds the $300,000 penalty due on early payoff. By the way, the journal entry to record this early bond retirement would include a credit to cash for the $10,300,000 redemption price, a debit to bonds payable for $10 million to remove the face value of the retired bonds, and a debit to loss on bond retirement for the difference, or $300,000. This loss on bond retirement is an expense reflected in other revenues and expenses on the company's income statement. It's the cost of the penalty charged for early retirement of the bonds. This accounting can get considerably more complicated when the retired bonds are originally issued at a premium or discount and payoff occurs between scheduled interest payments. For example, let's assume that 8% bonds were originally issued on April 1st of X4 at a $100,000 discount. Assuming interest is payable annually and the discount is amortized on a straight-line basis, what entries would be required upon early retirement of the bonds on July 1st of 20X6? In this case, an entry would first be made to update the bond interest expense through the date of retirement. That's done by crediting interest payable for $200,000 based on $10 million times the 8% stated rate for 3 months from April to July 1st, crediting discount on bonds for $5,000 given amortization of the $100,000 discount for 3 months of the 5-year or 60-month bond term, and debiting interest expense for the total of $205,000. The payoff of the bonds would then require a credit to cash for $10,500,000, which includes the $10,300,000 redemption price, plus $200,000 of interest payable through the date of retirement. The discount on bonds account would also be credited for its remaining balance of $55,000. That's equal to the original $100,000 discount, less the 2 years and 3 months or 27 months of amortization to date. Since the bonds are now retired, there's no reason to maintain any balance of the original discount on the company's books. Bonds payable would then be debited for the $10 million balance, along with interest payable for $200,000 and loss on bond retirement for the difference, or $355,000, which includes the $300,000 penalty and the balance of the discount balance written off. That $55,000 discount was really deferred interest expense to be recognized over the remaining life of the bonds. However, given early payoff of the bonds, that future expense is recorded now as part of the loss on early retirement of the bonds. These two entries could have been collapsed into one combining entry, and that would have been fine, but this approach we've used here is certainly acceptable. You know, it's actually possible to retire bonds before maturity, even if they're not callable. That's done by simply buying the bonds in a secondary market as they become available from investors who wish to sell the bonds prior to maturity. The accounting for such a purchase would involve the same entries we made here when accounting for the payoff of callable bonds, except in this case, the amount of cash paid and the resulting gain or loss would be based on the market price paid for the bonds rather than some previously established redemption price. Okay, let's go ahead now and have you do this last problem on early bond retirements provided here. This problem states that on December 31st, X5 purchased and retired $1 million of its previously issued bonds for $970,000 cash, including $10,000 of interest payable at the time of retirement. Then, assuming premium on bonds account has a remaining balance of $20,000, you were to prepare a journal entry to record the purchase of the bonds. This entry includes a credit to cash for the full $970,000 amount paid, a debit to interest payable for the $10,000 payment of what we'll assume was a previously recorded obligation of interest payable, a debit to bonds payable for the payoff of the $1 million face or principal amount of the bonds, a debit to the premium on bonds account to close out its $20,000 remaining balance, and a credit to gain on bond retirement for $60,000. This amount includes the $40,000 saved on the repurchase of the bonds at a discount, or the $960,000 net payoff of the $1 million bond obligation, plus recognition of the remaining $20,000 premium that was apparently received upon original issuance of the bonds. You were then asked two questions. First, why would the current purchase price of the bonds be lower than their face value when the bonds were originally issued at a premium? You know, bond prices are a reflection of market values, and a bond's market value fluctuates over time with changes in the effective interest rates demanded by investors. Those effective rates are influenced by a number of things, including the overall state of the economy and a company's changing prospects and perceived risk. In this case, the declining market value of bonds over time means effective interest rates demanded by investors have increased since the bond's original issuance. In fact, the effective rate at the date of purchase has apparently increased above the bond's stated interest rate if the bonds are now worth less than their face value. That could be the result of higher interest rates in the overall economy or simply greater perceived risk in corporation. The next question was, how does this early retirement of bonds improve financial position? Well, any payoff of debt lowers a company's debt ratio, or the amount of total debt to total assets. That also means the company's relative debt to equity is reduced, and generally speaking, companies that have lower levels of debt relative to their total assets and equity have greater financial flexibility in the future. In addition, lower debts can improve a company's profits if the interest costs saved through debt reduction are greater than the earnings that could have alternatively been achieved through investment of the surplus cash.